How has it changed over the years?
Well, I'd say the biggest change was Russell came along and began defining it as a asset class with a definition, et cetera, et cetera. That didn't happen until the mid-'80s. And then after that, this whole conversation began to evolve, to migrate, to become a next generation conversation around value and growth, which I happen to dislike as if it's a binary distinction. But that is where the world has gone. And today in the headlines, they talk about, value doing better or growth doing better, et cetera, et cetera. It's become way too much of a, you're either left or right-handed.
How would you describe, your approach at Royce in the kinds of companies that you are investing in?
Well, it's a great question because small cap is so broad and there really are so many ways to make money legitimately. There is a deep value component of people buying for, odd, out of sync valuations. We do some of that. We do a much higher quality value where we require a dividend, and we do lots of that. And then we do a variety of other, what I would call more quality-centric.
Right.
So we do a variety of things. But I don't mind the word value, but I don't like this big kind of binary distinction that you have to be one or the other.
And why are you insisting on a higher quality, a kind of a higher bar for you to get invested in international small cap stocks?
We think a lot about what makes high quality. And of course, the usual things matter, balance sheet, returns, et cetera. But honestly, we're spending our time thinking about whatever features that company has that enable them to get those high returns. We now want to scratch our head and look 5 years, 10 years out and see what could be durable. What features are durable. So we spend a lot of time on that, but risk of the enterprise, not all of the companies in the small cap space are high quality. In fact, there's a wide range. 30% of the Russell 2000 don't earn money.
Right. And you're not playing in that, you're not in that sandbox at all.
By and large,
as you said.
No,
right.
No. But it's a huge sandbox, obviously. So the asset class is volatile. We take a risk management approach to the asset class. And that is an important, that runs through all of our product profiles. So even when we have a area where we're investing in riskier stocks, that particular group is still highly conscious of the risk profile and manages it with more sensitivity to volatility and price. Now we have other zones where we are looking at companies that are exceptionally high quality, where really the risk is a different risk. The risk is one of, are these durable features going to persist? And will whatever the market is saying about those companies, which probably is giving it a high profile, will that persist? So we're making a second sort of a behavioral judgment, which is a different form of risk management.
As far as valuations, one of the things that really surprised me that I learned from Royce was, how well the small cap stocks have actually done in the last 10 years. Because if you read the headlines, you're thinking, small cap stocks are lagging large cap stocks. And yet the performance has been pretty spectacular, like one of the best decades ever. Are valuations stretched in the small cap world like they are in the large cap?
Your main point is, small caps have lagged large caps. Well, big deal. The numbers are terrific for everybody. The large caps are up 16%, small caps are up 14%. I mean, phenomenal.
Who's going to complain? I mean, that is phenomenal.
Measured in any way, those
Right.
absolute returns are among the best. It is odd that small cap in this good decade lagged. Now, it is typically not lagged, sort of in each decade. In fact, in all decades, it is not lagged. So it's a little bit of an anomaly.
Right.
But more importantly, every 10 years really has to stand on its own. In the wonderful market we've just are having, we had these super FANGs, let's call them. They dominate the large cap in HAB. Now, they're showing a little, possible stress in all sorts of ways. All it takes is a tiny amount of money to move from this, large cap space to the small cap space to have an impact. I think that will be going on or is going on currently.
There's another divide, which is between value and growth within the small cap universe as well.
Value has underperformed in this 10-year period, rather dramatically, like 400 or 500 basis points. I've always thought of the Morningstar box as missing a third dimension called quality. You have capitalization, value growth, and it's missing quality as a third dimension. More or less, our approach with value is with quality. More or less, quality doesn't do well in the first year of a bull market. In this weird thing that we had coming out of COVID, where there was a scary moment in the middle of COVID in March of 2020, where survival was an issue of many, many companies.
Right, because the economy shut down. Yeah.
The economy shut down. God knows what was going on in the world.
Right.
But the recovery has been dramatic for those companies that survived. Mm-hmm. In fact, they typically weren't not high quality. So quality lagged, almost rightfully so, because the $2 stock that survived went to 4, went to 8, and returned to survival as opposed to disappearing. Whereas the very high quality small caps didn't go down as much and they didn't go up as much. And quality wasn't worried about surviving. They're worrying about prospering.
Right.
Quality will do better in this now that we've sort of sorted out the first year. Quality, I know, will do better. I feel much better about how they're performing. And quality, either as a sort of compounder type company or quality associated with value, I feel is the right place to be for the next 2 or 3 years.
What kind of environments do these small companies tend to do best in? How do they fare if inflation does, tick up and stay higher for longer?
I think the higher quality companies will do very well.
Because of pricing power?
They are just programmed to do it. That is in their DNA. And I believe that it will be another reason why high quality does well in the next couple of years. They have pricing power.
One of the big trends in the markets in recent years has been the application of ESG standards and environmental, social and governance standards. What's your view of that movement?
We are a long-term investor. A long-term investor had better do their solid work on everything that affects the company. And all of those factors, what the company makes, how they operate, how they govern themselves, and what they stand for with their employees, with their customers, they are critical to a long-term success. So we have no problem with that standard evolving as a as a kind of public standard. These are basic building blocks of great companies.